everyone, to another episode of Trading WTF. We're joined today by Ian Foster. In this episode of Trading WTF, we're pleased to host Ian Foster, lead educator at beawinningtrader.com. He is committed to helping others in their path to success. A little bit more info on Ian. Ian Foster is lead educator to Be a Winning Trader and has been training traders since 1998. He began his trading career in the mid-'80s and started attending seminars in the '90s. Back then, he noticed how lackluster and unhelpful those seminars were and began a quest for finding a good trading methodology. He has since specialized in price action trading and is committed to helping others in their path to success. Thank you, Ian.
Welcome. Not at all.
So maybe let's
jump with you.
Yeah, great. Let's maybe jump into. It's pleased to have you. Let's maybe jump into kind of where you started trading in the '80s and what that looked like.
Yeah, well, I mean, when I first started out trading, I hadn't absolutely got a clue about anything. And obviously, as we all have, anybody that's involved or an interest in trading, I obviously had an interest simply because I knew that you could make some money. And as a young person, I wanted to make money. And from my accent, those that don't know, I'm actually from Northern Ireland, although I've been living in the UK mainland this last almost 27 years in another couple of months. So what happened was there was a fellow businessman who had been doing some stock buying, and he actually owned a local manufacturing business, and he happened to tell me one day about a particular share that he had done very well with. And in passing, I said to him, look, if an opportunity arises again, or a similar opportunity, please let me know. Now, at that particular time, I had two businesses. I was an estate agent, and also we had a local pub restaurant business in our local town in Northern Ireland. And he arrived in one Monday morning, and he said, Ian, I think that same share that I had some success with come back when I told you, I think there's another opportunity today to buy that. And anyway, never bought a share before, hadn't even got a broker's account, so I hadn't. But to cut a long story short, I did buy that share on that particular Monday morning. It was a penny share. I got in contact with a broker that was in the same another town in Northern Ireland, and the same town that our accountants were in. And I happened to ring him up and I says, look, you don't know me, but I want to buy some shares this morning. I haven't got an account. It wouldn't happen today, Michael, let me tell you, okay? But I haven't got an account. But if you want a reference, because I want to buy these quickly, contact my accountants in Newry, and he obviously knew the boss men of that accountancy firm. So to cut a long story short, I did buy the shares, and all I had then in my own office was a teletext, TVs with BBC teletext, and this particular share, which was a company called Rotaprint, and all I was able to see was the price of the shares moving up or down, and in this instance, thank goodness they moved up. I bought them at 8 3/4 pence and sold them on the Wednesday at 12 3/4p. So I'd made myself £2,000 sterling, and this was in the early 1980s, and that was also in those days, not like today. It was an accounting period, so therefore the accounting period were in 2-week cycles. So if that happened to be on the Friday of the last day of the accounting period, I would have had to pay for the shares on the Monday. But it just also so happened, luck was on my side, that this was the first day of the new accounting period, which meant that I, technically speaking, had 2 weeks credit. But I didn't need the credit, thank goodness. So I had no money down whatsoever, bought the shares. He was getting a little bit nervous on the Wednesday because he gave me a phone call. This brokerage was owned by two brothers. And I think you should maybe consider selling. And I says, well, look, if they exactly go to 12 3/4 pence, I will. So at £2,000 profit, that gave me the bug, as you can imagine. So I now the trading bug. I'm going to make a lot of money very, very quickly. This is a fantastic business and a fantastic game. So that's what initially got me into trading, buying shares. Again, I had no clue. I was looking at papers going forward, taking advice from this one, that one, and not really knowing much about what I was doing. But it always going pretty well until the 1987 stock market crash. And lo and behold, there was myself sitting high and dry with stocks that had now fallen quite considerably. So I lost money there. Well, I kept some stocks, but I had to sell some. But that was still part and parcel of the learning process, I think, in this business.
So where do you go from there? So then how do you start learning and building your methodology from that point?
Yeah, so what happened then? Obviously, I moved on then after that because I started reading about the derivative markets. So I started then derivative trading based on options and futures. And in the UK here, as you probably know, we have spread betting brokers, but in those days, there actually wasn't any. In fact, maybe IG markets, or as we know now as IG Index, that were IG markets today, then they were known as IG Index, were very much in infancy. They did become more commercialized. So at that particular time, when I was trading the FTSE futures, one contract was £25 sterling per point. And you couldn't trade at £10 per point. You couldn't trade at £5. It was either one contract or nothing. One was the minimum. So I started trading options, then under the futures markets, again with the belief that I was, going to make money very quickly. And it was then that I realized that I didn't know very much at all, and I had to learn an awful lot more. And I needed a methodology. I needed something that was indicating from a chart perspective, now off charts, off graphs, that I could then be able to make my own buy and sell decisions. And that's what started me looking for a methodology.
So then, okay, so now you're checking out all these courses, you're reading all these books, and that's when you're realizing in the seminars that there's something that could be better. Is that it?
Yes, it was, because what happened was, obviously, in modern times, we're in a totally different scenario, because again, then I have to honestly say, as you would understand, the internet was very much in its infancy. It was non-existent. And when it was, we were plugging into a telephone line. So, there was no trading online or nothing. In those days, you were ringing the broker. And even after, quite a few years after that, you were still having to ring your broker. Even IG Index, which is, I became a client of theirs, you were ringing up if you're doing a spread bet with them. So, also at that time, there wasn't the same information, from sellers, from people like myself, training companies to do these, training events. But there were a few about. And obviously I attended those few, always looking for something that was going to give me, a methodology. And on each occasion I came away, yes, they were informative, definitely were, but not what I was looking for. And dare I say it, probably what many others were looking for. And that was something, look, here's a way from which you should here's a method, or here's how you can read this chart, and this is indicating weakness, and this is indicating strength, and you should perhaps buy here or perhaps sell there. None of that. So that's when there was frustration. And of course I was trying to trade, not paper trade, there I said. I was trading as well as trying to learn. So it was costing me money at the same time. So as I've said recently, I think to somebody, it was through probably a little bit of number one, determination, but I think number two, stubbornness, not wanting to be defeated, giving in, that kept me in the business at that time. And then I was lucky enough to be introduced to price action trading, and it was actually from a guy over in the US he became a mentor of mine. So he did, and that turned it quickly began to turn my trading fortunes around. So it did, and that started me off.
Well, I guess before we jump into price action, maybe let's chat a little bit about what the markets used to be like, because there used to be people on the trading floors. There used to be one calling in a brokerage. Then once they call in the brokerage, they take your order. Then they pass the order on to the people on the trading floor, and then they, buy, sell, bid for the best price that they can get. And I guess with the advent of the internet, all of a sudden came. I think FX was the first real tradable asset online. That just prices moving all day long, and And then recently, I guess with the Robinhood phenomenon, you're able to buy fractional shares because, as you mentioned before, you had to buy lots. So you were stuck buying 100 pieces of one share, and now you can buy 1 share, 2 share, 5 shares, and half a share. So trading's really come a long way.
It has, and I mean, young people now today, and we're all young, including yourself, Michael. Maybe I'm an old codger here, but anyway, I'm not that old. I feel young, but anyway, some days I feel young, other days I
as long as you feel young, that's the key.
But anyway, you're quite correct. It's totally different. Even in my early days with IG Markets, which were the first spread betting company in the UK, I mean, I used to ring them up and, buy on the FTSE and buy 20, buy 10, and they would be shouting across. And I remember one day in particular, because obviously there was a guy that were keeping the book. And I remember one day I was going long the market. I was buying the market. And somebody was shouting across, short 20 or something like that, And I said, no, I want to long 20. No, he says, I'm shouting across. So they were balancing. So they were even shouting across their own office. And then they were going into the general market. Obviously, they were taking so much on and they were hedging. And then, when it was unbalanced, they were going into the general market to make sure it was always balanced. That was in the early days. Obviously, things have changed and moved on quite a lot since then,
Yeah, well, I guess so many more institutions, so many more players all holding up the market. Yeah. It's definitely more robust, but at the same time, during certain events, it can feel like it's very, very thin as well. So.
Oh yeah, and you mean you've got, as you probably we all well know as traders, that even the guys that were on the floor, and in the futures floors and over in the States, they came in when it went electronic trading, and a lot of them that had been successful floor traders, and on the floor all of a sudden tried to mimic that when it went electronically, and quite a few of them really struggled with it for a long time, So it's a totally different feel.
Yeah, I remember just getting back in, just starting around in the brokerage business, and we had some clients trading, and there was an out trade, and I go out there and I have to go do like 600 million in the market, and I just just put like boom the big trade in there all at once, and then like the market, you see a candle just drop all at once. Then they call me up. They're like, listen, you have the platform, but you got to place those orders in a lot smaller. Otherwise, the risk. The Treasury Department called them up and was like, "What the heck is this guy doing?" I was like, "I was just covering our exposure." They're like, "Yeah, can you do it a little softer than that?"
Yes, of course.
And then I was like, "Well, this is $1 trillion a day market, but me putting in half $500 million, that definitely every billion adds up, I guess."
Of course, very much so. Probably, yeah. No. But that still happens today, as even the electronic market, when you're going into, level 2, obviously, putting in brokers' floors or putting in small amounts. So, they're trying to hide their transactions, aren't they? That's what they're trying to do if they can. As much as possible. I'm not saying totally, but as much as possible. And probably for stability purposes too, yes.
All right, well, I guess we left off at price action. Let's jump into price action. Maybe give us a little bit of info. What is price action? And then we can go deeper.
The way that I describe price action is looking at past and present price movements on a chart and using those to predict what the future likely direction is going to be. That's basically what price action is. So you're not relying on indicators. If you're analyzing correctly price action, there's no indicators or nothing required to do that. It's pure price. So there's a great advantage in that, and that means that you haven't got a lagging indicator. It's not lagging. And let's face it, every indicator, and I have a piece of software myself, a trading tool that I developed, but every indicator, including it, is slightly lagging because it's taking the information from price. Unless you go into some of these AI indicators now that people are starting to try and develop on that, they're trying to predict market movement and that. So with price action, it's not. So that's the best way, I think, to describe past and present price movements to predict with probabilities the next likely direction in that particular market on that particular time frame.
And when you're looking at that, Is there certain charts that make a difference? Is it like line charts, bar charts, candle charts?
Yeah, no. On my analysis, Michael, all my analysis is done on the open, high, low, close chart. So not a line chart. Certainly
Candlestick
not a line
charts?
chart, not a candlestick chart. No, and the reason being, and here's the main difference between an open, high, low, close chart and a candlestick chart for me. On all our analysis, we are more interested, or I am more interested in where the close is in relation to the high or low of the bar, because the close in price action of any bar is actually the confirmation of the price action in that bar. It determines whether there's greater selling pressure or whether there's greater buying pressure, depending on whether the close is closer to the high, indicating greater buying pressure, or whether it's closer to the low that it closes, indicating greater selling pressure. Now, you're getting the exact same information on the candlestick chart. The only difference is whether you have an open body or a closed body on a candlestick chart depends on where the close is in relation to the open. But the opening price is the oldest price, no matter the time frame. So therefore, it's the price with the least significance in my analysis. Okay, it's the closing price is the greater significance. And you may get an open body candle, in other words, that it has closed above the open, but it is actually closed below the mid price of that particular candle bar, the bar range of that candle. And therefore, if you're looking at an open, high, low, close chart, you would say that that is a bearish bar because it is closed closer to the low, and therefore there's a greater probability of that low being broken before the high. Whereas in a candlestick chart, you can have an open body, although the close could be a bearish bar close or a bullish bar close with a closed candle body. So that's why you get a more definitive. I know in modern times, you go into brokerage offices, probably in your own instance, it's candles, candles, candles. And I can understand that because you can look and you can see the bodies probably a little bit clearer. But believe it or not, from my analysis and my price action analysis and all the training and teaching that I do and mentoring is all based on open, high, low, close charts. For that one reason.
I guess it kind of takes away some of the extra noise, I would say.
Yeah, probably does. Yes. I know that, you hear a lot of people talking about when they're looking at candle charts about the wicks of the candles and things like that in the body. It's either one thing or another. So as I say, it's the close that we're more interested in. And you can see that clear in an open, high, low, close chart for me. You can see the close, whether it's closer to the high or low. And I'm not interested. I don't want, even if the open wasn't marked on the chart, it wouldn't really matter to me. I'm more interested in where the close is.
And I guess, what does the close mean to you from that perspective?
Well, because what the close is, if it closes, as I've said, if the close is closer to the high of that particular bar on any time frame, then it means that you've got a greater probability of that high being broken. And all we can do as traders, when we're trading, investors, whatever way you want to, whatever class you put yourself in, all you can do is work on probabilities. We can't work on certainties, unfortunately, trading. So we only can work on probabilities. So therefore, if you have got a greater probability of the high of that particular bar being broken to the upside, then and you're taking a long trade, then that is giving you that greater probability that the market will work in that direction or will move in that direction. Does that always happen? Of course it doesn't. But let me tell you how powerful and how much emphasis I put on that. Obviously, the larger the time frame you're using, the greater that analysis on a single price bar becomes. So in other words, a daily price bar, a weekly price bar is going to be more have a stronger magnet than a daily price bar. A daily price bar is not going to be it's not going to be as strong as a weekly. But a 60-minute will not be. You can't put the same emphasis on a 60-minute as you can a daily. So, and right down to a 1 minute, 5 minute, 15-minute. In other words, I'm talking about from a reliability perspective, from a probability perspective. But let me tell you, I was trading today in our live trading room, and I was trading off 8 range charts on both the E-mini and on light crude oil. And even an 8 range chart, which in the E-mini, that's 2 full points just as an 8 range bar because they work on quarter points. But if you're taking the crude oil market, every ninth point, in other words, once you have an 8 range, it goes into the next bar. So it's not even a 1 minute or a 3 minute. I would never take a sell signal on a bullish bar, or I would never take a buy signal on a bearish bar close. That's how important it is. Does it mean that it doesn't mean shoot up and go in the opposite direction immediately the next bar? No. But remember, as I've said, this is all down to probabilities.
Well, if it's probable, it's inevitable. That's what I say when it comes to risk management.
Probably, yes, indeed, yes.
Yeah, because every time you're always thinking, "Oh, this is not going to happen. It's not going to." But if there's a probability that it could happen, it probably might happen.
Yes,
it is inevitable for there to be the exception to the rule every now and then.
Yes, of course.
And are there any certain patterns to look for while looking at the open highs or the close?
Well, what I look for when I one of the regularly asked questions is, how do you determine what to trade each day if you're a day trader? And what's quite important, if you have, for example, a prime example was today, pound yen, GBP, JPY was a very bearish bar yesterday. So the daily bar yesterday was a bearish bar. In other words, it had a close closer to the low than it had to the high. So therefore, there was a greater probability that yesterday's low on the pound yen was going to be broken to the downside. This morning, when I came and opened my charts over the overnight trading, the pound yen was trading inside that range, right? So it had moved up. It hadn't went down.
Inside bar, I guess, or
it was
inside.
An inside. That's right. At that stage, it was an inside bar. But remember, based on my analysis, by looking just at one single vertical bar, open, high, low, close bar, there was a greater probability for that market to be going down. So if I want to trade in the direction of the bigger picture, the bigger trend, I would only be interested then from an intraday perspective of taking sell signals. If you were taking buy signals, if you were getting them, then there would be what we call counter trend trades against the daily time frame chart. So what happened this morning was it was a beautiful setup, because there was an early buy signal, and I'm talking about 8 p.m. UK time. So this was, 4 or 5 hours, 5 hours back from Eastern Standard, and so it was the beginning of the London session. So, or just after. So what happened was the market did give an initial buy, which only lasted about 10 or 12 pips. And then all of a sudden we got what we call a lower high, right? Like a lower swing high. Yeah. And that market indicated that once we have a lower swing high, the objectives then are for it to go lower. And again, then we had the daily bar telling us that we had a greater probability that the market should take yesterday's low out. And goodness gracious, it was, you take a look just at today's pound yen trade, and intraday it went way, way down. Of course, news come out then, and it skew-widened a little bit at 12 p.m. Excuse me, when the Bank of England announced a 0.5% interest rate, but it went back on its track again. But prior to that, I was in a beautiful trade. Well, it was a beautiful intraday trade. It was a small trade, probably in pound yen terms, but there was about 35 pips there that I was able to lock in. So it was fine. But if you look at it now, this time of the day, it was probably about 135 pips. But there was the large range bars at the time of the news,
Yeah, well, it's all making sense, because when I had the chance to do one of those bucket list things and go to the New York Stock Exchange, and I got to walk on the floor over there, and seeing the trade. And just I got to speak with some traders that were sitting there, and I was like, what's your tip for success? And he's like just follow the momentum. So he's really just watching the tape. He's just watching the tape and the numbers and nothing else, and he's just seeing it's going up or it's going down, and that's it. So it falls in line with your theory. The price action is just following the price and where the action is taking it.
Yes. No, and then, if you want to take it a step further, then obviously, what's the common term is swing highs and swing lows. And, we have the teaching that I do and what I use myself on a daily basis, because not only am I an educator and mentor, I am a trader, so And therefore, on that basis, we've a rule set to determine when there's actually what we call a swing high. We call the vertical bar trading pattern high because it's the open, high, low, close, vertical bars. So, but as otherwise known as swing highs and swing lows, and we have an exact rule that determines when there's a confirmed swing high or swing low in place. And then, if there's a lower swing high, high, so in other words, a lower high, swing high, then that's indicating that the market should make a lower swing high low, and vice versa. If there's a higher swing high low, it should make a higher swing high. So that's what we do then. We take it a step further using a particular rule that determines when that is confirmed. And we know at the time, not after the event. Anybody can look at a chart, Michael, as you know, after the event. And even if you're trading swing highs or lows or any methodology that you want to choose, and you can pick out, we should have been buying it there, and we should have been selling it there, we should have been doing this. But what you need to know, you need to have something that is solid and that is consistently pretty good with minimalistic risk. That doesn't put you as a trader through much pain. And I'll explain what I mean by pain in a minute. But you should have a system that does that there, and know at the time that it's triggered. There's no point looking at a market or a share. I've often looked at shares on a fundamental basis, and they're showing real good fundamentals. But when you put on the chart, you would love to be buying them down here, not where they are now, So it's a matter of getting into the new trend as quickly as possible once it's confirmed, and then being able to control your risk, knowing strategically where your stop should be. What do I mean by that? Well, if you have a method, I say to anybody, we talk about successful trading, but we all know that risk is the difference between being successful or unsuccessful from a trading perspective. But you cannot control risk if you haven't got a methodology from which you are using on a trading plan, because if you've got a methodology that is indicating, based on probabilities, that there's a greater probability of a market moving up or a greater probability of the market moving down, you need to know when that particular analysis is wrong. And you need to know at what point that is wrong. So if it's giving you an indication that this is what it should do and it doesn't do that, you need to know at the exact point that it doesn't do that. And that there means then that now you've got a strategic place from which to place a protective stop. And that is very important. And if you haven't got that, then don't be trying to trade, because you're only gambling. We want to take calculated gambles, calculated risks.
Well, hope is not a trading plan. This is my is what I say. And yeah. And well, speaking of your trading methodology, could you maybe describe a little bit about it and some winners, some losers, and some lessons?
Well, I think the main lesson from any methodology is being able to be patient. And
okay, I'm so impatient.
You've now got a rule set. You've now got a methodology with a set of rules. And let me tell you just a little bit about mine. The great thing about it, it's not subjective. Okay, so we go into looking at Elliott wave theories and things like that, and if you get 5 or 6 Elliott wave technicians in a room, you're maybe getting 3 or 4 different analysis of the particular market move of are you in wave 3 of an ABC correction or whatever the case may be, or an ABC correction, wave 3 or wave 4 or wave 5. So it's subjective, as we know. With the methodology that I use and teach, it's not subjective. So if you and I were looking at the same instrument and having the same data, I have to say that because same in, you get the same out. That's what I'm saying. If you whatever goes in. So in other words, if me and you were looking at the same instrument, looking at the same data, and on the same time frame, it would be impossible for you to have if we want to call it the buy signal, and me to have a sell signal. That would not happen. It can't happen because there's no subjectiveness. It's a set of rules that are set in stone, and that is it. The issues that we've got then, obviously, you could give me, Michael, or I could give you the best trading system in the world, okay, the best available. But if you don't follow the rules set to that, you might as well not have it. And the rules set to that at times is waiting on the correct setup. And today in the live room, if I'm thinking there was a particular entry. It might have been. It was on the E-mini. The market had it was strong before the official open, the US Open, and the market then came off quite a bit, and then the market was going back up again. And I think just before we closed the room, and there was a trade, and I was I said to myself, look, folk, I would love to take this, and I'm glad I'm in a live trading room because I'm being disciplined, because maybe if I wasn't, I would maybe just pull the trigger that little bit quicker. But, it turned out to be good because the E-mini then started to rally. But I'm saying, so it's all really down to having, as you know, and that is the problem from a human being perspective, is having the discipline to then wait on the trade setups. And, you're waiting on a trade setup. The worst thing, there's two bad things. The first thing is you're waiting on a trade setup and it's not happening. So what do? Take a chance. And let's face it, probably 9 times out of 10, that chance will fail. Just seems to be Sod's law that's going to happen. It's going to fail. Or the second, and it's probably a bigger problem, this, and is chasing. So you've now had a losing trade. You've now had a second losing trade. Now, or perhaps maybe if you're a day trader and you're intraday up and you've been up X number of points or pounds or dollars or whatever, euros at a particular time, and you continue trading instead of saying, thank you, Mr. Market, that has been quite a good day. You continue trading because we're a human being and we get the greed and we go on and we start losing. And then we're back to break even and you're saying, no, I want to get my money back. I want to be back up. I was up $500 there. I was up with and what happens? Disaster. So that is all a human perspective, and nobody, that comes down to the mind here. So
we call that revenge trading.
Revenge trading, chasing. It's like the guy going into the bookie's office, isn't it? And he puts 100 quid in a horse and he loses, and the next time he puts another 100 quid and he loses. The next thing he said, I want to get my money back, and he puts 200 quid and it loses. So instead of being down 100 quid, he's now down 400 quid. So
yeah, it's those emotions, but you can, I guess, developing discipline only happens after you feel the loss and after you can learn from it.
Yeah, you have to be.
Unfortunately,
if you can be disciplined, I think the big difference between being successful and failing is discipline. Yes, we talk about a methodology and have something. You need something, but after that, it's discipline in relation to what everything you do around that. You need to have some sort of a trading plan. Why am I buying this here? Why am I selling it there? You definitely do need to have that. And this goes for trading, and it also goes for investing. So you need to have somewhere where you should be coming out of something. I seen away before the 2008 financial crash, and some of the bank shares, even here in the UK, it got to the stage that one of the shares was falling quite a lot, and even their own banks were recommending their clients, look, this share's fallen now from £6 just down to £3, and it's falling lower. It's a buy. Now, could you imagine that the investors that maybe had been holding that share on the whole way up, and all of a sudden they let it go all down? And that was wrong advice too. So you need to have a cut-off point. You need to have something. So this is where I think fundamentals are great, but you need to have a chart, a methodology from which to say, well, hold on, if that passes that support line, breaks through it, I need to be out. That particular share I'm talking about, it went to 12 pence from about £6, and I bought some of it at 20p. So there you go. It wasn't great advice from their some of the bank managers advising their clients to buy it when it was down, when it had only fallen 50%. But anyway.
Yeah. Well, I guess we talked a lot about price action. We talked a lot about trading methodology. Do we go into some of what the world looks like today and some of the markets?
Yeah, of course. Yes. The work. Well, obviously, today is probably not a bad day, Michael, to be talking about, but between yesterday and today, because last night with the FOMC raising interest rates, we had the Bank of England today raising interest rates, and we had the European Central Bank raising interest rates. So that's what the world looks like: rising interest rates, inflation out of control. Probably, I think, not well managed. And I say this, and I think this is where banks now us as the people on the land, we're suffering now. People with mortgages, people with rising fuel costs because of the Ukraine-Russia war, etc., etc. But I think going back to coming out of the pandemic across the Western world, I think this is where the central banks were wrong. The central banks were, they were this quantitative easing, and they were pushing money into the economy, when really, because of the lockdowns, because of manufacturing, because of deliveries, you could see, even, I don't mean, you could see that there was going to be a problem in relation to goods. But there was going to be such a demand for the goods because there was the money there, because they were being flooding the economy in many ways with money. And all of a sudden, prices just absolutely went up through the roof. You take motor cars, you take cars here. I mean, thousands, not hundreds. I'm talking about average. I'm not talking about the upper market cars. I'm talking about average run-of-the-mill cars, your Volkswagen Golfs, your Audi A3s, things like that, just went through the roof because people had the money, but there was no cars available. And new cars now, because of the chip scenario, were not coming through. That's only one example. But I mean, so now what's happened? Inflation has taken off, and we know why, or we know why a great reason of that is. So that's out of control of the central government or central banks. But then, or any government, I mean, it's quite bemusing at times when each of the sitting governments in whatever country you're actually from, they're blaming the government for this. But, this is a worldwide problem. It's not actually an individual government situation.
Well,
say, from a Russian, a lot of it comes from this war, unfortunately. But coming out of the pandemic, I think they should have been tightening banks at that stage, should have been tightening the supply of money when they could see that there was going to be a supply issue across. Now, this is before the Ukraine war, but there was going to be a supply issue for goods. So therefore, instead of giving people plenty of money to actually buy those goods that were now not available or becoming scarce, and therefore putting the price up, they were doing the complete opposite. So there's a big problem there, to be quite honest. Certainly there, but now they're now overreacting, because now what they're doing, increasing interest rates, and it's a bit like a train or a ball rolling down a hill. Once it gathers steam, and don't get me wrong, I'd be pretty confident probably each of the Western, each of the central banks in the Western world are probably going to overstretch, and then they'll start coming back the other way, because it's very hard to stop a rolling ball, as we know.
Yeah, but you're still seeing prices rise at the grocery stores every month.
You are.
And so just as you think, okay, maybe the inflation is kicking in, it's prices are rising. And then in Canada, house prices aren't falling; they're staying flat. Even though interest rates keep rising, they're still flat, and that's because even though they've recently just said that they're not going to be allowing foreign buyers to buy homes without a significant tax, and they're still bringing in almost 500,000 immigrants a year now, and at least half of them have good money behind them. So as soon as they become a permanent resident, as soon as they get their residency, they can buy a house. There's the loophole around that. So you have a large group of wealthy individuals coming from different countries buying houses over there. And still, even if you got money in China or somewhere else, you don't care if you pay a heavy tax to buy a property, because in 10, 20 years, your money is going to be there and it's going to be in a stable currency. So it's not going to stop the flows from coming. So you're having a housing market that's still stabilized, even though it's probably should be much weaker with the interest rates that they're pushing in there. But it's really just making it more expensive for the people who live there to buy it and to buy homes. And you still have a heck of a lot of there's more jobs than there are people looking for jobs in Canada and the US.
Yes, yes. Well, you know, the same problem here in the United Kingdom, the UK, no question about that. And also, I would say, probably, I mean, house prices are probably pretty stable here. They've maybe fallen back a little bit, I'm told. Maybe not much. But the problem that you've got, maybe it's okay talking now, because a lot of people are in fixed mortgages. And it's not until, even including in you know, so it's not until they're coming off those fixed mortgages. So all of a sudden, their mortgage payment that's at this level is now jumping to this level. And then perhaps the criteria for buying, you know, for getting a new mortgage is definitely, you know, it's more expensive for a start. And probably the disposable income has been taken into consideration, and it's probably, you know, a greater requirement there. So it might have an effect just as we speak over here anyway. I don't know about any other country, but I would assume probably across the board that eventually, if the rates will keep rising and they don't start dropping before these fixed mortgages that people have been in, or the greater majority of people are in. I know there's not everybody in a fixed mortgage. Obviously, some of them are variable rates, and their mortgage, you know, was greatly increased this last 6 or 7 months, 8 months. But I think that's probably what's helping a lot of it, Michael, probably is a fixed mortgage rate. So I know that it got really tight in the United Kingdom here, UK, from around October, when there was a little bit of instability in the government, and a change of prime ministers and change of prime ministers again. But I think the rates have started to stabilise now. Obviously, today up 0.5% is quite a significant move again, like, to be honest.
Well, in Canada, everybody was on the juice. Everybody's thinking, oh, we got like 1.5% interest rates. Let's keep the variable. Why would I want to pay 2 or 3%? And then I bought a house last year, and I'm just like, and then because like I'm a business owner, it was hard to get approved with the bank, and I was like, man, I want my 1.25%, and I was like, livid. And then they're like, oh, and then I have to go to a B lender, and they're like, oh, we can lock you in at 3.88 for fixed for X amount of years, and I was just like, but they're saying they're keeping interest rates low for long, and I was like pissed off, but I was like, all right, whatever I got to do. I got a wife, I got a baby, whatever I got to do. And now interest rates are, after these recent interest, it's like 6.5% after you do bank plus prime, almost 7%. So interest rates have almost doubled, tripled. Like, well, they've more than 500% raised interest rates in Canada, 500%. So that's.
So you're glad you went into a fixed rate then, obviously.
I'm super happy I got a fixed rate. Yeah. And now I'm worried that the bank is going to come after me saying we want to change the terms of your loan.
My son my son just had bought a property this time last year, but it was a renovation property that we done up, and then he just got a mortgage on it towards the end of, when was it? The end of the summer, probably around June, maybe July, August time, got it mortgaged into his own name. And let me tell you, he's very lucky, because he's in a 5-year fixed I told him to go into. He got that, and by golly gracious, well, you know, it's made a heck of a difference that he was lucky to get that compared to where it would be today. Yeah.
Oh yeah. Well, we got lucky. And well, and I don't see interest rates coming down very, very soon. People are like, oh, they're at some point they're going to have to start reducing. I'm like, I think it's going to stay here for a little while. I think that's the only way that you're going to get like deflationary prices to come in, is when people start to feel the pain, and then it can go back to normal.
I think the Fed have said last night, like, I mean, there's another couple of rises on the horizon, like, you know, so it's not going to stop with their rate yesterday. And I mean, I didn't, because I was doing a live trading room today, so I don't know exactly, but I know that the governor of the Bank of England has come out with some statement, so I don't exactly know, as I'm speaking to you, exactly what he said. But interest rates, maybe they're saying, I did read one of the headlines to say that although they're accepting that the UK is going to go into recession, it may not be for as long as for that was first thought. So that may be some help. But I don't know what he said about the interest rates, but certainly, look, they're doing their best based on inflation. But remember, this is slightly different this time, I think, in relation to inflation. Inflation usually is created because of the amount of money that people have in disposable
Money
income,
supply.
and buying. But really, we're in a different scenario this time, Michael, because actually it is it's the non-supply. It's the shortage of goods, and a much lesser much greater shortage, I should say, not lesser, greater shortage than what we have been used to over for many years. Whether that be groceries, whether it have to be food products, whether it be motor vehicles, whether it be materials, everything now you're waiting on. So I don't know whether the interest rate, the policy that they're going for really reflects exactly the main cause of this inflation. The main cause of this inflation has been coming out of pandemic, and then a double whammy with Russia and the lack of oil and gas and things like that. So there's an issue there. So it's not just down to the public of the world that's creating the inflation this time. It's more like the pandemic and the can we say the Russian government? But anyway.
Yeah. Well, I don't know if you read some of Klaus Schwab's books. He in it, like I read the Great Reset, and then I read the narratives one. And the narratives one is like he's like, you got to create a story so people understand what's happening to them. And in his book, he's like, yeah, interest rates need to be really, really high in Western countries. And that was like in 2019, 2020, I read that book. And I was like, but they're saying the interest rates are going to be low for long. And then I'm like, they're printing money and everything. I'm like, and then they created the narrative for it to happen. The war in Russia and Ukraine. And well, I guess because Europe is so dependent on all their energy from Russia, that makes sense.
Yes.
But it's the narratives are coming so people understand what's happening to them, and when you read the book, you're like, how's this gonna happen? This is really, and then I'm like, now we're living in it. I'm like,
we are.
Holy crap, Klaus did it.
I know. Yes, and that's to be polite.
Yeah.
Holy crap. Yes.
Yeah. Mm-hmm. So I'm like, but yeah, there's these things happening that are economics wise, things don't make sense. But I guess geopolitically, they're connecting with the economics and they're making it make sense.
Yes.
And I guess leading into the next one, in Europe and UK, do you think they're going to dodge a recession? Because like we've all thought the U.S. is going to run in there once you raise interest rates, but the U.S. is they're still pumping out and they're still growing.
Yeah. Well, I think in both instances, I doubt, Europe and the UK, as I say, they would just even very recently, I think Europe, they have acknowledged that they're going to go into recession. And as I say, the UK have certainly, because it was announced, it was further reiterated today, that they're definitely going to go into recession later in the year. But that they reckon it's going to be, as I've already said to you, briefly, and I haven't read it in detail, but they've said that it's going to be shorter than what was originally anticipated. So how that works out, I do not know.
Yeah, well, I know we were at the event together with Simon in London, and then I think after the event I went to grab a burger, and I saw you at the same burger place, and that was one tasty burger. I forget the name of the place, but I'm gonna have to go back there when I'm back in the UK. Hopefully they're still around. But like, when I look at the conversion on my credit card statement when I get back to Canada, I'm like, so I just have a $35 burger? I was like,
oh yes.
And then like I'm like, what's that gonna be when I come back there the next time around? Is that gonna be a $50 or $60 burger?
I know it's frightening actually. Yeah, you're quite right. Well, of course, as we know, when you go to the likes of London and the major cities of the world, things are inflated anyway, Michael. You know, so.
Yeah, that's true. Well, even in Mexico right now, I'm going to the grocery store and I'm like, okay, I spent like $60 on groceries last year when I was here, and now I'm all of a sudden spending almost $150, $200. So
Yes,
it doesn't matter where you are in the world, everything is getting more expensive, everything's getting more complicated.
yeah. No, you're quite right. Very much so. Yeah, I mean, for my sins, I like a bottle. I like some brown sauce. Right, just for whether I'm having a burger or something else. And my dear wife, who does the shopping, has said to me just recently, from it being around £2 for one of these bottles of sauce, I think last week in our local Tesco store it was £3.40 or £3.20 or something crazy, just for a bottle of brown sauce. We were just talking, that's not a 10 or 20% rise. It's quite a significant rise.
That's just like under 100%, just under 100.
Yeah. Crazy.
So it's crazy. I'm curious where they calculate these inflation numbers or what they're doing, but
yeah, me too.
Well, I guess we're rounding up, closing to the end. I guess what are some of your biggest trade ideas coming up for the next month, next quarter? What are some things you're looking at in the markets?
Well, I mean, one of my favorite markets is crude oil. I trade the light crude oil futures markets, and I obviously look at gold. And from a trade idea perspective, probably it doesn't change. It doesn't change. I'm probably many of my members are trading. I want to call them a trading family, but members that have been taught and mentored by myself and continue to be so. I keep saying trade what you see, because I think making predictions, is dangerous. Can make a fool out of you very quickly. It can make you look a very smart person when you get it right, but you're probably getting it wrong about 250 times, and then you're getting it right once. And of course, it's the right ones that you only hear about. So from trade ideas, it doesn't differentiate from today from it will be next week or next month. Look at price bars from a price action perspective. I'm probably stocks. I would be bullish enough. I think later on, certainly, I think that there could be a bit of money put into the stock market. I know pensions maybe are an area that's going to be looked at. I'm not sure just how some of these big pension funds are going to handle everything. But so from an idea perspective, I certainly just trade what you see. Probably be reasonably bullish. I know that crude oil has taken a hammering over this last couple of days, maybe longer actually. And I'm surprised that it's even fallen quite heavily today. Again, obviously with the rise in interest rates last night in the States, and with probably Russia coming out and saying that the supply. So, but again, I'm probably bullish of crude oil. I believe crude oil is going to be an awful lot higher before the end of the year. But again, just because of my thoughts, I could eat those words, as you know, Michael. Okay, but I can't trade on those thoughts. You have to trade what you see in front of you. So my trade ideas would be very much look at what you're trading. Look at the foreign exchange markets, if it's commodity markets, if it's stock markets, shares. Look at those. Look at the charts. Look always to the left of your charts, as you would know. Look for support and resistance lines and use those from somewhere, a platform from which to trade off, and be wary of that. That's my trade ideas. Look always to the left of your charts from a technical analysis perspective. From a fundamental perspective, there's that much going on. I don't think we can't look very far at all ahead. I don't believe, I think when you've got the central banks and governments of the Western world not sure what the next turn is going to be, it's very hard for individuals like ourselves to do so.
Well, yeah, I agree with what you say. Trade what you see. Oftentimes, you have a trade idea, and well, this is what the world looks like, and then I think this is where the market should go. But for some reason, it takes a while for that trade idea or theme to really take place, and the markets are going in another direction. And so, yeah, I like to say, I don't really have a sentiment with regards to where the market should go. I think wherever they're going, you should follow the momentum and go with it. And so,
yeah, it's like a friend of mine, Michael, a lady who we've lost contact in recent times, but a great trader, her husband and her, but he was in the oil industry. And she was a character. We got on really, really well. We actually met at one of my original seminars many years ago. Okay, and we kept in touch ever since. But she would be trading the markets, and her husband would have been very much a fundamentalist. So he'd have been reading about whatever was going on in the U.S. economy, and obviously at this stage we were in the bull run. The market was going up and going up and going up. But she kept saying, Ian, have to sell the Dow Jones, have to sell it. I says, but you can't, look, the market's going up, Debbie. And she'd say to me, no, husband, I'm not going to mention names, but my husband, Mickey, well, broke it now, I said, but my husband, look, Ian, this cannot go up. Well, let me tell you, they were selling it. And the market was going up when they were coming out, and they were selling it again. It was going up because we were in a massive bull run. So fundamentals, if you have that attitude and saying this can't go any higher, this needs to come back because of this X, Y, Z. Let me tell you, that's when the market's always right, Michael, as we all know.
Oh,
so,
yeah.
Sometimes you like to think that I can dictate. I'm going to be right. A question I got within the last couple of months, this year, well, no, probably this year, so the last 6 or 7 weeks, from one of my clients, Ian, we've had the most wonderful setup. Our software paints the price bars, Michael, blue is a sign of strength or red for weakness, etc. So he says, we've got blue price bars, we've got a higher confirmed swing high, we've got a daily bullish bar, and we've got a buy signal on, I forget the instrument, let's assume it was the euro dollar. But he says, Ian, it only went up a little bit and then it came down again. He says, what's wrong? What happened? So I said to him, hold on a minute. What you say and what you've explained is 100% correct. You've had the correct setup. There's nothing we can change about that. The only thing that we can change is we cannot determine if that market decides to go up a little bit more and then slam down again. So again, it goes back to us what you've already said. Trade what you see, and just because you've got the most perfect setup and the most perfect trade idea, remember that doesn't mean to say that it's going to do exactly what it should do just because you think it's the perfect setup. That's the important aspect. So again, if we give the markets respect, no matter what time we go into the market to trade or what instrument we're trading, if we give it respect and use protective stops, I think that's the way forward.
I guess leading us into the finish then, tell us a little bit about Be a Winning Trader, how traders can work with you, live trading rooms where they can trade with you and see what's going on in real time and trade the markets real time.
Yeah, well, it's www.beawinningtrader.com. And as I say, I've been mentoring and educating since 1998, but not only that, I am a trader. So the methodology we teach, as we've touched on, is a price action methodology. And then I have a unique proprietary software trading tool that sits on top of that actually helps to simplify the process. And as much as it paints the price bars red as a sign of weakness, in other words, there's more selling pressure, blue is a sign of strength and more buying pressure, or they are painted green as a sign of neutrality. In other words, nobody's in control. So therefore, if you've got a bullish price action set up and now you've got a bullish price bar painted blue, you've got a probability in your favor. So how we teach that is you become a member of our trading family, I call it. And we teach that by doing live trading rooms on a weekly basis. We teach that by group training sessions, of which we had one last night, UK time. We differentiate the times for different clients. And we then have unlimited email support. But most importantly, Michael, from my perspective, I do one-to-one training. So I'm the founder of Be a Winning Trader, which is the trading name of STB Trading. And I'm also the lead educator, as you've already stated. So therefore, I teach on a one-to-one basis people. So it's not a matter of me giving you access to the members. So if you become a member and you get access to our members area, it's not just a matter of you going in there and watching videos. Yes, there are videos in there, and I encourage people to go in there and learn the basic rules of our methodology. But certainly where you come in, where I think our service comes into its own, is being able to do the one-to-one mentoring. So we're able to do one-to-one mentoring with people, and it's unlimited. Because we want you, the good thing, as I've said to you from the outset, it's not subjective. So therefore, once you learn the rules, you will be able to pick the signals just as well as me. It's not that I'm always going to be one step ahead of you or vice versa. We're all going to be on a level. So it's only the matter of getting people up to that particular level. That's why I'm able to do the one-to-one training. And between that and the live trading rooms, I think group training sessions are fine, as we know. But it's a bit like reading a book or going to the internet. And you read something or you see something on the internet and you say, yes, that there is going to work really well. All of a sudden then you go into the live market and you start scratching your head. I just don't see that setup that I'm after reading or somebody's told me about. So it's great then when you have somebody that you can actually contact and say, look, can I have a meeting with you? Can we have a Zoom call? Can we have go over some charts together? This is what I'm a little bit confused with. So I'm able to do that. So that's all by signing up on our website in beawinningtrader.com. Beawinningtrader.com.
Sweet. Thank you for joining us today, Ian. Everyone, you can find him at beawinningtrader.com. And just so you know, when you're looking at the charts and you're trying to figure out where to focus or you're trying to figure out what the F is going on, please know you're not alone, and check out Ian and see if you can learn some more from him. Thank you so much, Ian. Really appreciate you joining us today.
Thank you very much. Thank you very much, Michael. All the best now. Bye-bye.